Well, welcome back to all of our VITA volunteers. My name is Jim Simpson, and on behalf of the Central Arizona VITA Network, Masters of Coin, and the City of Phoenix, we're preparing a series of videos to help all of our VITA volunteers get certified for the 2025 tax filing season. This video will begin session 5. In the last video, the last session, we discussed both credit, non-refundable and refundable credits. The last video was talking about non-refundable credits. We're now going to continue with a discussion of deductions, both the standard deduction and more specifically itemized deductions. Session 5 will then also continue on with a variety of things such as the Affordable Care Act, Obamacare, if you will, and we'll cover that part in a succeeding video of session 5. And then now that we would have covered all of the basic information you need to get certified, and we will put in a third video after deductions here that will talk about the new Tax Act that was enacted on July 4th, 2025. Those things will not be covered on the tests that you have to take to get certified, but you will need to know that information to work in a VITA site. So let's take a look at our agenda for today. And this agenda is actually for the whole session 5, which, as I say, we're going to split up into 2 videos for this agenda plus a third video to discuss the new Tax Act. So today we'll start off with reviewing homework. Then we're going to go into most of this. Today's video will be on the standard and itemized deductions right here. Where then payments and estimates will just take a few minutes to cover, and that'll give us a good stopping point so that when we come back to video 5B, we'll talk about the Affordable Care Act or the marketplace, Obamacare. You hear it by different kinds of things, and then a variety of miscellaneous forms and other taxes that will round out session 5. So let's get started with reviewing the homework. And so I'm going to share the test booklet. Now, I want to be sure that you understand that in some of the examples that we've used in the prior videos, I used the data from 2024 returns, right? But this review is going to go over the actual 2025 tests that you have to take. Now, of course, I'm not going to give you the answers. The whole purpose of this is to just go back and recap what we've learned so far and show you resources of where to go find the answers that you need. Because as I said before, that's the real important part of what they're testing you on here. Is not did you memorize everything to then go take on a final exam. It's do you know where, do you need to, do you know how to recognize what you don't know? And then go look up the answers for those things. So if I scroll on down here to our table of contents, of course, we're looking at the advanced scenarios. That was 2. So we want to go here to start on page 75. So I'm going to scroll on down here to page 75. Now, again, you've already been working on this, I hope, okay? And so we've already talked about some things on these questions, but I told you to just ignore the portions that we haven't covered. Of course, we had covered filing status. Oh, as I'm thinking about this, I want to reiterate, as you take these tests, don't just stop with the regular test. Take the retest as well. The retest follows this section. The advanced test, there's the test and then the retest. The scenarios are exactly the same. The questions are very similar. They just ask it in a different way. Like, for instance, this question where we talked about filing status, right? This is a true or false question. Well, on the retest, they may give you a multiple choice question, right? That says, what is Joy's filing status? And that might say single, qualified surviving spouse, married filing jointly, married filing separate. And if you answered true to this one, and it wasn't one of the options in the second one, hey, maybe you think I better go back and review my answers for that, right? So that's why it's important to take both. Um, so let's continue on here. Now, we had not talked about the earned income credit the last time we reviewed this test. We talked about the earned income credit in session 4, in video 4A, where we talked about refundable credits, right? So now here it's asking who could claim the earned income credit. And if I go back up to the fact pattern, what do we got? Joy's husband moved out, no contact with Peter since he's moved out. He's been gone a long time, but they're not legally separated. So that's important. Joy's got one child. Um, Joy's 31. She earned 46,000 in wages. She paid all the cost of keeping up her home. She provided over half the support for Valerie. So those are the facts we need to know to be able to see who could qualify for the earned income credit. And so it looks like our choices is it's either Joy, Peter, the father, both of them, or neither. So where would you find this answer? So if I go back into publication 4012, there's a whole tab on the earned income credit. I believe it's tab I. So I'm going to scroll on down here. G, H. There we go. Yeah, so I is the whole tab is on the earned income credit. And I would get very familiar with, of course, we've already talked about what earned income was, and that could get a little tricky, but in the general rule is I think you kind of understand that. Here it's going to say, what are common EIC filing errors? Claiming a child who doesn't meet the residency and relationship requirements, or married taxpayers incorrectly filing as single or head of household. Okay. Those are kind of big filing errors. Now, here's where you're going to find most of the answers to these questions right here. Here's a summary of the EIC eligibility requirements. So part A is going to say rules for everyone. So taxpayers and children must all have a social security number that's valid for employment by the due date of the return. You must meet certain requirements if you are separated from your spouse and not filing joint return. So that would be the case in this. So I might want to go down and read this footnote 4 here to make sure that I'm doing everything right. I won't go over all of these things, but I think it's fair to say that we have a qualifying child because Joy, she's been separated the whole year and her daughter lived with her for that. So, this is an important thing. This is, in general, this is important too, because these rules, they differ a little bit from the dependency rules. Like, look at this one. Child must meet the relationship, age, residency, and joint return test. Those were the same tests that were in the dependency chapter that we talked about. But look here, the child does not have to be your dependent. Oh, but not the support test. And the child doesn't have to be your dependent. Now, there's a footnote too. I would go kind of read that just in case. In other words, here's where you're going to get the information to be able to answer that question right here. Good. Okay. So let's go back into here. I think we've already talked about here whether you have lottery winnings or income or not. Okay. So scenario 2, here again, now they're talking about credits. So we haven't covered those. So let's take a look at this one. So what do we got? Matt and Megan are married and filing jointly. They're US citizens. They've got 2 children, Janice age 8 and Jack age 17. They're both US citizens. They've got earned income. In order to work, the Summers paid $2,000 to their son, Jack, to care for Janice. So we got Jack up here and then Janice up here after school. And then Matt and Megan provided all the support. So for which children can Matt and Megan claim the child tax credit? Okay, so where are you going to find this information? Okay. Let's go back into our 4012, and I'm going to go look up in the table of contents because up in here, and I think I'm going to try to make this a little bit easier to see here. There we go. Yeah. Okay, so I'm looking for, okay, here we've got tab G, non-refundable credits, and here's a whole section on the child tax credit, G5. I'll make this bigger so you can see it. Okay, so here are the rules for the child tax credit. And get very familiar with these rules and where to go look it up, right? Um, I see one right here, child must be claimed as your dependent, which is different than the earned income tax credit, right? So that's why I say and trying to memorize these is almost a futile thing unless you've got like a photographic memory. I don't. I've been doing this 35 years, and every year I have to go look this stuff up, right? At least the first couple times that I'm doing taxes in the year. So go look at these rules, and then I think you can apply it to here and determine what the answer is. Now, the second one, the summers qualify for the child and dependent care credit. Don't confuse that with the child tax credit. This is they're caring for somebody. Remember, we talked about, what are the rules for that in our last video. But let's go look in case you forgot or you don't want to pull up the last video and scroll through all of that. Let's go look in the 4012, see if we can find the rules for that. Actually, I think I'm just going to scroll down. Yeah, because it's just a couple pages after the child tax credit we talk about. Does your qualifying child qualify you for the child tax credit? Or, okay, sorry, I'm sorry, this isn't the right, this was child tax credit and other dependents credit. Okay, I was wrong. I'm looking for the child and dependent care credit. And I know I'm probably giving you a headache, so I think I'm just gonna, here we go. So this starts on page G14, child and dependent care expenses. So first thing is, who is a qualifying person, right? It gives you the ages here. Only the custodial parent may claim it. Okay. Person who's it has to be self-cared. Here's where it talks about qualified work-related expenses. And it remember, this was something I kind of emphasized. Expenses must be paid for the care if the taxpayer is working or looking for work. Okay. Here's this. Now, here are some probing questions, right? I'm also looking for here, and this is where you would enter in TaxSlayer. Okay. All of these are going to give you information about this. I was looking for more of a chart that more summarized it, and it's not there. You've got to kind of go through these. I think most of the information you're going to get would be in this screening sheet. This is what you probably have to work through to be able to answer that question, right? Um, yeah, okay. I was just looking to see if there was anything else that was um, more relevant to that question. Okay. So, then the fifth one, number 5, says the summers qualify for the child independent credit. Okay, yeah, that's where we were. So that's what you want to go looking for to see. So you want to make sure is do the kids qualify? Who did they pay it to? You know, um, and all of that should be found in your publication 4012. Okay, let's go down and look at scenario 3. And looks like this is going to be talking about the health savings account, which we haven't covered yet. Okay, we're going to cover that. Oh, I'm sorry, we did cover the health savings account. Yes, okay. So the first one is Nancy is eligible to contribute an additional how much money to her HSA because she is 55 or older, right? So if you don't remember where that is, if I go into the 4012, I'm going to go back up into the table of contents, and a health savings account is really part of an adjustment, is a type of adjustment. Um, There it is, health savings account, E13. Okay. So I would go look on this. And so I guess what are we looking for? What are the limits in it? Do you get an extra amount if you're older? Okay. And I think you'll find your answer right on that sheet right there. Okay. So now this one I found to be a little tricky. Form 8889 Part 1 is used to report HSA contributions made by this. And yeah, I don't remember what's on part 1 of the form, although it's very simple. Just go Google Form 8889 and look at the form and see what's reported on part 1. Okay. Um, and I think that'll give you the answer to your question. Total unreimbursed qualified medical expenses reported on 8889 part 2, right? The medical expenses that qualify are in your 4012, right in that section I was just kind of showing you. You can go through, just make sure you're looking at all of these expenses and see, do they qualify? Do all of those qualify? I think one probably should stick out after to you. Okay. Scenario 4. What was this one? Okay, so this one is about the earned income credit, right? Which we covered in our last video, or second to the last video. That was one of the refundable credits. Okay, so Alexa's age 62, single, owns a home, provides all the cost. This was that complicated one. This is for, I guess Alexa's the grandma, Amy's the daughter of Alexa, and then Lillian's the granddaughter of Alexa. Okay, so now what they're looking for. Now, we already talked about whether you can claim them as a dependent, and I warned you to go look at um, the when more than one person can claim them. And I think we may find the same, it's not exactly the same, but sometimes, first of all, there can never be two people who get to claim those credits, right? It's one or the other. So let's go look at the rules for the earned income credit. Remember, I told you that was under tab I. So we'll go down here to tab I. And I think what you probably need to look for is, are there rules? Who gets to claim the granddaughter? And I would go through this chart. I especially, yeah, okay, there's more here. These are the general eligibility rules. I would look at that. I believe there's a section in here. Yeah, here's with the rules with a qualifying child. Okay, so you want to go through all of these rules and see if okay. There may be rules to where the child could be claimed by two people, and is there a hierarchy that does that? Oh, there we go. That's what I was looking for. Qualifying child and more than one person. I would go read through all of these rules to make sure that maybe we made the answer about who can claim her as a dependent, but remember, saw just a moment ago in one of those charts that said for purposes of the earned income credit, they don't have to be your dependent, but they could, in this case, I suspect they could be the qualifying child of more than one person. So I would go review these rules really carefully. Okay, that was 4. 5, looks like 5 is we're going to be talking about um, itemized deductions, which we're going to talk about today. So we'll come back to this one the next time we go review it to see um, about itemized deductions. So scenario 6. So here's one question about the American Opportunity Tax Credit, and I'm not even going to go to 4012. I emphasize so much about getting familiar with tab J with the education credits. And that tab J is going to answer this question for you right away. Okay. And then this one about whether Carlos would owe an additional tax of 10%. That's what we're going to cover in the second half of session 5. And 5B, we'll talk about those other taxes. So we'll cover that a little later. And then what was in 7? Oh, this is Martin and Yvette. Yeah, this is the one where they had the 1099-R where with the annuity, the joint and survivor annuity. But this is where Martin's a 5th grade teacher. Okay, let's see what the questions look like. I'm going to scroll down here to the questions. Are we in scenario 7? Did I? Oh, yeah. Okay, we're in scenario 7. Okay, so this is the one where you have to do a tax return. So I've said this, but I really want to emphasize this, okay, is your goal here is to make sure you prepare an accurate return. Because if you prepare the accurate return and then you print a PDF of the return, then that has all the answers below. Okay, so we're not going to try to answer these questions without you having done the return. But just for a quick thing, what is the taxable portion of her pension? Again, you do the return, use that simplified method or the outside calculator we talked about from Colorado Tax Aid, right? And that'll tell you this one too. Now, are they eligible to claim the credit for other dependents? I'm still going to suggest that you do the tax return and just go look at page 2 and see if it shows up there. You could answer this question on your own by going into the 4012. We were just kind of on that page a minute ago where we talked about the credit for other dependents. That was right after the child tax credit, right? And you could answer this question looking at the facts, but I would just do the return, right? Other income, same thing. You could go look at the rules for income and then go up into the forms and see if make sure you got everything and make sure you got things from the fact pattern and the forms. Okay. I wouldn't do that. I would prepare the return. Okay. And then I would go look at Willis's Form 1040 Schedule 1. That's going to give you the answer right there. And if you don't see the answer, go check your input on the return. You probably missed something. Okay. Martin is eligible to deduct qualified educator expenses in the amount of, again, this is something we could go into the 4012, into the adjustments section and find out what eligible educator expenses are, or we could just prepare the return and where in our fact pattern, it said that Martin had so much of educator expenses, just put that in the return, finish the return, and then go look on the Schedule 1 and see how much they allowed. Okay. Again, this could be answered by, just generally. And if you try to get it off the return, you still got to know what the regular standard deduction would be to determine whether they get a higher one. Or you can look in your 4012. This is a pretty easy question, right? Which expenses do not qualify for the American Opportunity Credit? Now, of course, your return's not going to tell you that, but if you put it in properly, if you were going through those expenses and you looked in tab J, as to what qualifies for the American Opportunity Credit, you should be able to find the answer to this one right away. Now, here's another one, taxable amount of EVET Social Security income. We talked about the taxability of Social Security income, and it's very complicated. It's like you have this one floor or ceiling, you might call it, or floor. Once you pass a certain income level, then 50% of it becomes taxable. And then as your income goes up, the percentage taxable goes up until you hit kind of the maximum ceiling, which then 85% of it's all taxable. It's almost impossible to figure that out from a formula. Just do the tax return and go look on page 1 where it tells you what's the taxable amount. And you should see the answer right here, okay? And then total income tax withholding. Well, you could go through the forms and just add it up on a calculator, or just do the return. Go look on page 2 of the 1040 where it talks about how much withholding. There's 2 places for withholding, right? Although it does give you a total too, so you should be able to see that. So the same strategy is going to work for doing advanced scenario 8 and scenario 9 as you do the returns and then go look at answering those questions. So I hope that that was some help. Let's get back into our presentation here and start talking about itemized deductions, okay? So the general concept here is what is a standard deduction versus itemized deductions, okay? The standard deduction is given to anybody depending on their age and filing status. And here's where you're going to find those. Now, everybody, if you've turned away, pay attention to this one. This is really important, okay? First of all, TaxSlayer will calculate the correct standard deduction. But I always keep telling you to go to your 4012 and look for that. And we're going to go there right now. And this is important. Write this down. If you've got the physical book, open it up to this page. If you're using a PDF like I am, open up the PDF, because the October revision is incorrect about standard deduction amounts. That's why this is important. So I'm going to stop sharing here and go back to my 4012. Here's the 4012, and I'm going to go up here to the table of contents, because we're going to look at this quite a bit here. And we're looking for deductions right here. So standard deduction. This is going to give you a chart of the standard deductions. I want you to do what I just did. I crossed out what the 4012 has because it's incorrect. The correct standard deductions, and I wrote them out here to the side, are right here. Now, a moment ago I said you don't really have to memorize these, but you should be familiar with them, at least the rounded amounts. And the reason why we're going to start talking about, well, are you going to itemize deductions or just take the standard deduction? This standard deduction is for everybody based on, here we go, whether they're single or married filing separate, whether they're married filing joint or qualifying surviving spouse or head of household. There's more. I'm going to scroll down to the next page in the 4012, right? There are additional standard deductions, but I've put a highlighted thing here. All of these deductions amounts must be adjusted for the correct base standard deduction on the previous page. So this is a little chart, and I'm going to just summarize what this chart does. If you are 65 or older, you get an additional standard deduction, again, depending on your filing status. If you're single, it's an extra $2,000 if you're over 65. If you're married filing jointly, you get $1,600 extra. But see, these amounts are actually wrong because they were basing it on, like single, basing it on a 15,000 standard deduction. You have to base this on, if you're going to use that chart, you have to base it on the correct standard deduction, then add $2,000 to it to come up with the correct standard deduction here. Now, not often are you're never going to have to go calculate this. You should just be aware of the general thing, because what we're going to talk about today is if you total up itemized deductions and they're more than the standard deduction, then you're going to itemize your deductions. Now, again, TaxSlayer, if you enter in all of your itemized deductions, it's going to take the larger of the two. So you don't really have to calculate it. But if you're having a conversation with somebody, you want to be able to at least give them rounded amounts. If you're single, your standard deduction is around 15 or 16,000 bucks, right? If you're married, it's like 30 to 32, something like that, right? If you're head of household, I think it's like 23,000 something, right? At least where you've got the general idea of it. Okay. Again, there's this worksheet for dependents, and again, they're looking at 15,000 when the correct number would be 15,750 here. Okay. Okay. So let's get back into our presentation and start talking about standard versus itemized deductions. Okay. So as I said, you're going to choose whichever is most advantageous for you. Okay. If your itemized deductions total up to be more than your standard, you're going to itemize. Okay. Otherwise, you'll just take the standard deduction. Okay. So they should itemize if their itemized deductions are higher. But now look at this, married filing separate. There's a special rule, and this might be intuitive to some of you, but if you're married filing separate, which of course we don't do, but here's another reason not to, your standard deduction is halved, and if one spouse itemizes, then the other has to itemize. I think you could probably kind of see what people might have tried to get away with in the past, where you're married filing jointly and say, well, hey, I'll take all the itemized deductions, so that'll put me way up over the limit, and then you take the standard deduction. No, 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 no. If you're married filing separate, one itemizes, the other has to itemize. Standard versus itemized deductions, ever since the Tax Cut and Jobs Act in 2018, we're up to where the latest statistics said 90% of taxpayers take the standard deduction. I actually think it's a little higher than that for 2025. I saw some statistics that said it approached 95%. And then I would tell you further, in a VITA site, I know that this is much higher. We don't see very many itemized deductions on returns. Once in a while, and you've got to be aware of them, okay? But mostly people are going to take the standard deduction. If you are not sure if they'll be able to itemize, just go ahead and enter all the deductions. It doesn't take that long. And sometimes taxpayers will insist on you doing that, okay? Yeah, they've been filing taxes since before the Trump Tax Act, where they always itemized, and they just can't believe that they would take the standard deduction. Although more and more people are getting used to that now these days. But you can just enter everything, and then the software is going to take the better of it, okay? Here is kind of a tip. A moment ago I was saying, at least be aware of the general amounts of the standard deductions, because you sit down with the client and they're pulling out all kinds of medical receipts and charitable contributions, and you want to think, okay, do I have to enter in all of these things? Are they really going to itemize? Here's a big tip. If they don't have mortgage interest, it's really rare that they would itemize. Or if they had medical expenses, but careful, the medical expenses, the first 7.5% of AGI are not even allowable as an itemized deduction. That's a huge amount. If you've got a $50,000 AGI, that means the first $3,750 of medical expenses don't even count. Okay, so unless they've got huge medical expenses, they're probably not going to itemize. But these are the first two things to go look at, because all the other stuff, right, is never going to count up to be their standard deduction. If they don't have one of these two things, and you can look, I don't want to say never would they take the itemized, but that'll give you a quick little go-to to doing it. But as I said earlier, if the client wants their deductions put in, just do it. Don't argue with them. Okay. Um, one of my colleagues who developed these slides, he he tells a story of how he sat down with somebody who just insisted, and he knew they weren't going to itemize, and he put them all in, said, okay, we've itemized your deductions, and I don't know what they came out to, but I'll just say they came out to 25,000 and they were entitled to 32,000. So you want us to take the 25,000, right? And of course, they said, no, 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 give me the standard deduction, right? But so just as a side here. Here are the correct standard deduction amounts. Our slides have them correct. It's the 4012 that are wrong. So again, just to summarize, it depends on your filing status. And then it also, and I left something out. I did talk about the additional standard deduction if you were over 65, but there's also another one if you're blind, legally blind. Now, there's some people, they sit in front of you and they can kind of see around the periphery. They know if they're legally blind, and it's a status that a doctor's got to certify. I forget what percentage of vision that it is, but they'll know, right? And if they're blind, then they get even an additional standard deduction. So if the spouse is, if we're doing married filing jointly and add 1,600 for a taxpayer spouse at 65 older, but or if they are blind, okay, add another 1,600. Okay, so here's would be that thing. Add 3,200 for each person that is blind and 65 or over. If they're single or head of household, the additional standard deduction is 2,000 if they're over 65 and 2,000 if they're blind. So it's either 1,600 or 2,000 for each of being blind or over 65. That increases the standard deduction. Again, TaxSlayer, there's a little checkbox um, when under the basic information. I showed you there was all those extra questions, and one of them is, are you legally blind? And if you check that box, then TaxSlayer will know. And of course, you've got to put in the date of birth so TaxSlayer knows if they're over 65 or not. Here is another case where you may really want to just enter all the itemized deductions. Because a moment ago, I told you that medical expenses are only deductible if they exceed 7.5% of your AGI. Okay, that's on the federal return. Arizona, and you may want, if you're from a different state, check your own state rules. But in Arizona, they allow 100% of medical deductions. So, and it's completely legal and possible that you take the standard deduction on the federal and you itemize on the state. So if they do have a bunch of medical expenses, and even though you know they're taking the standard deduction on federal, you might want to go ahead and just enter all the stuff to make sure they don't get a little bit better benefit on the state return. Okay. Now, we talked about the Arizona tax credits in our last video, such as the charitable contributions for Arizona tax credit. And I told you back then that over 90% of our filers are taking the standard deduction, right? And I told you then, go ahead and enter in 100% of all charitable contributions, even if they're taking the tax credits on Arizona. The basic concept here is that you can't double dip. You can't deduct it as a charitable contribution and then use that charitable contribution to use it as a taxpayer, as a payment of your taxes on the Arizona return. That's getting kind of double dipping, right? And I told you back in that video, if they're itemizing deductions, we have to do this a little separately. Okay. We would enter all medical taxes, contributions on the federal return. But if they're taking some for the Arizona tax credit, a charitable contribution, let's say they're taking $1,000 to Habitat for Humanity, that I'm not sure they even qualify for that. We'll say St. Vincent de Paul. Okay. I know they qualify for it. But, and just to keep numbers round, they're going to use $500 to offset their Arizona taxes. Well, in this case, we only want to enter in the excess of the contributions that aren't being claimed as a tax credit. We enter $500 as a charitable contribution. But hey, we're not done, because somebody went to court and sued, and they said, well, look, yeah, it may not be a charitable if we're using it as a tax credit, it may not be a charitable contribution, but it's a payment of taxes. And so therefore, we're going to find out in a minute, you are allowed the payment of state taxes is an itemized deduction. So in this case, we would go in and enter in the part that we're paying for the Arizona tax credit, we would enter it as a tax payment. So just first of all, I just told you all of that stuff. Don't get too caught up in it. You're only rarely going to see this, but if you're ever itemizing deductions for somebody and they are taking state tax credits, get your site coordinator or somebody who's got experience involved, because there's some special things that we have to do with this. So here's the screen in TaxSlayer, and it's got two things for standard deduction, itemized deductions. I rarely ever go into this. In fact, I'm not sure what we have to do. I think that there's a choice to say force it to take the standard deduction, which it does anyway if it's higher. But here's the screen we'll use a lot to enter in itemized deductions right here. And so before we get into that, let's just kind of do some little practice off the top of your head, right? So if single, the standard deduction is $15,750, but we put in all their itemized deductions and it comes to $15,759, which type of deduction is best? Okay, I think you know, an itemized deduction. It's only $9, but see, this would be one of those cases where you're not really sure. And once you put it in, well, TaxSlayer is going to automatically itemize deductions for them. If you're married filing joint, standard deduction is $31,500, but your itemized deductions only come up to $24,500. Which type is best? Yeah, standard deduction. Take the higher. Okay. Head of household, you've got standard deduction is $23,000, but you got $25,000 of itemized deductions. Yeah, you got it. We're going to itemize. Okay. So let's start talking about what types of itemized deductions there are. So medical and dental expenses, I've already explained this. The first 7.5% of your AGI do not count. But then we can do taxes. And where this will come from, it's like state tax withholding from the W-2s, right? That's a deduction. Any property tax that you pay on real estate, any vehicle license tax. In Arizona, this has to be a tax on the value of the auto, boat, or RV or something like that. There's usually registration fees. Those aren't deductible. It has to be the tax on the value of it. They call it ad valorem tax, right? But that's a deductible. And then sales tax that you might have paid on large purchases like a car or boat or something like that. Those are deductible. I said earlier, mortgage interest is usually one of the largest deductions that you're going to get. There's a limit. Of course, none of our VITA clients are ever going to approach that limit, right? Or they wouldn't be coming to us, right? So we're going to go over the Form 1098 that they get from a lender and discuss the various types, how you do the mortgage interest in just a moment. So here's that itemized deduction screen right here. And you can put in here, here's medical and dental expenses, here's the taxes that you paid, here's mortgage interest, gifts to charity, charitable deductions are in there. These went away. I don't know why they keep this in TaxSlayer. They went away in the Tax Cut and Jobs Act, and the last July 4th, One Big Beautiful Bill Act pretty much made that permanent until Congress changes it again, anyway. The only job-related travel expenses would be for military. You have to have military certification for that. Okay, so let's talk about some of these. So medical expenses are the expenses that you paid during the year. They could have been incurred in a prior year and you didn't get around to pay them until this year. We're looking at what you actually paid during the year. And they have to belong to either the taxpayer's spouse, or their dependents. Now, careful here. Sometimes if you're like a separated or divorced parent, and you're paying the medical expenses for your kids, maybe out of the goodness of your heart or by a divorce decree or whatever, you are allowed to count those too. Um, Here is the screen that you would get for medical deductions. And let me talk about a few things on this screen here. Okay. First one, and I know it's a little hard to read this, it says medical and dental insurance, right? And in this case, we have all the expenses listed here for York and Cindy Young. And so looks like they paid two types of insurance. They paid for a supplemental policy for York, and then Cheryl's Affordable Care Act or Obamacare insurance was $1,530. We just added these two up and put them in here, right? And then we've got doctor bills, dentist bills, and looks like these total up to $29.93. And there's two things. You can either add them together and put them in here, or if there's several, or if you just want to create a record for them, see these three lines right in here? You can do these three lines and then you can go enter them individually. Like here was the first one, doctor bills for York and Sydney, $26.53. Then we'd go up and click on here, add an additional amount, and we put in the dentist bills for them, $340. And so what that does is then total it up for us right here. The rest of these things kind of speak for themselves, except for, okay, so here's what medical mileage. You get a deduction cents per mile for the medical miles you had to drive to go to doctor's appointments or hospital visits, those kinds of things, physical therapy, maybe, whatever. Anything medically related, you get an additional deduction from mileage. And we put in the actual mileage here, right? Now, and there's a place for other medical expenses that you might want to itemize. In this case, it was insulin for Sadie. And yeah, see, this says no prescription. There's a place up here for prescriptions. So that's why they're itemizing this. But look at this last one. And you're not likely to see this in a VITA site. I don't know if any of you have looked into long-term care insurance. It's very expensive. And most of our clients don't pay for that. But it's possible. I have seen it, especially where we're doing elderly returns and stuff. So here there were long-term care policies, but there's some special rules for that. Your 4012 will have it. There's maximum amounts that you can deduct based on your age. And so when you click on this edit premiums here, I don't think I have a screen to show you that. No, I don't. It'll take you into a screen where you can enter in the most. And I think TaxSlayer limits it, but I'm not sure of that. You'd want to check that to make sure. And then look in your 4012. Your 4012 will have the maximum amounts that they can claim for this. So this is all your medical deductions. I'm going to reiterate one time. Only the amount that goes over 7.5% are claimed. I mean, so if they just show you, yeah, I went to the doctor a couple times, I got $40 in copays, okay? There's only one instance where you even want to bother entering them, and that's if you might deduct, you might itemize on the state return. Go ahead and put them in. It only takes a minute. Okay, let's go down to taxes. Now, here I told you that, for vehicles, you can deduct what's called ad valorem taxes, or that's the tax on the value. It's a property tax on the value of the vehicle. This is an Arizona one, right? And they split it out here. What is vehicle license tax? This is the only deductible part right here. All of these other things like registration fees or air quality fees, postage, those are not deductible. It has to be the tax on the property, okay? This is real estate, and you've seen this in our, when we went over Arizona tax credits. This is a tax bill. But remember, just to refresh your memory, they give you this tax bill, but the payments are due, the first half is due in October of the current year, and then you pay the second half next year. Remember, we are what's called cash basis taxpayers. We only get to deduct what we paid for in the year. So in this case, we paid half of it of the prior year's tax this year, and half of this year's tax this year. So we got to know how much. If we already went through all of the screens about how you could go find it from the assessor's office, so I won't go over that. So sometimes if they own the house and they're paying the tax bill, they'll come. You can pay the whole thing in one payment in December. Today's December 15th. I'm recording this, and I just went and paid my property tax bill, right? But so that way you don't have to split it up into two payments, and as long as you pay it by December 31st, no penalties. Right? So some of our taxpayers will do that. The majority, shouldn't say majority anymore. If they have mortgage interest, they're paying it to a lender. The lender will require that they set up an escrow account so that the lender pays the property taxes. They want to make sure that the home doesn't get foreclosed on for lack of paying property taxes. Now, after you've paid down your mortgage, then they allow you to not use an escrow account. That would be a case where maybe the taxpayer is paying the bills. And they either have to come and they have to know exactly what they paid during the year. If they said, well, I don't know, here's my property tax bill, we got to do more work to determine what they have to do. We have to go to the assessor's office, put in the parcel tax number, and get the tax bill. Okay, what are some other taxes that might be paid here? So right up here, it'll say additional state and local income tax, and it warns you, do not include the amounts from W-2, 1099, or W-2G. We entered those forms in elsewhere, and where it asks for state tax, we entered it in. TaxSlayer knows about that. If we double count, if we enter it in again here, we're double counting it. But this box is for instance, here's a very simple example. They come in to VITA site in April and prepare their state and federal tax returns. And remember, this box is only for state taxes paid, but we prepare their state return and they owe $150 on the state return. They have a balance due that they paid in 2025, right? And TaxSlayer doesn't know about that. So we're going to put in 150 there. There's also sales taxes are paid. And then there's a sales tax worksheet, and we've got little charts. I'm going to go into this worksheet here, right here. When we go in here for the sales tax deduction, you're going to want to put in their zip code, how many days they lived in this zip code. And then we have little charts there to where we can break out what is the local general sales tax percent. In this case, like Peoria is 5.6%, and what's the state general tax, which is 2.5%. And then also, here's where we would put in that extra sales tax on large purchases. 1565 we would put in here. So that way then we calculate the taxes. This is for real estate taxes. Now be careful here. We're going to show you in a minute where we enter in the mortgage interest, and there's a section in there that if the lender is paying the property tax, they report it on that Form 1098. And when we enter in the 1098, we enter in a portion for property tax. We don't want to duplicate it here. But this might be the case where the homeowner's paying their own property tax. We would go ahead and enter in the real estate taxes there. And here's for the car taxes or boat or whatever. Okay, mortgage interest. So mortgage interest is deductible for both a first and a second home, like a vacation home. And that second home could be like a motor home or a trailer or a boat, so long as they are fully self-contained, meaning they got sleeping quarters, kitchen and bathroom facilities. That has to be there to be considered a home. We can also deduct points. Points are usually when you purchase the home, you can pay an additional amount to the lender to buy down the interest rate. And if you do that, it's like prepaid interest, and we're allowed to deduct points. And then again, as I said, property tax paid. So let's talk about home equity lines of credits, or HELOCs. And these were very popular, back in the Reagan Tax Act. It used to be before 1986, you could deduct all the consumer interest that you paid on credit cards, cars, anything like that. You could deduct. The Reagan Tax Act took that away. And so but you could deduct any interest on a home mortgage. So people ran out and they got second mortgages or home equity lines of credits, right? And then paid off all their cars and credit cards. And so now they got a deduction for all the interest. Well, they put some rules into that to where you can get a second mortgage or a HELOC, but you can only deduct the interest on that HELOC if you used it for either buying the home, building the home, or improving the home, substantially improving the home. For instance, you remodel the kitchen or bathroom and you take out a second mortgage for that. That's perfectly deductible. There used to be a time when you would take out second mortgages to help meet percentages of home indebtedness. I forget exactly how that worked, but again, that was for the purchase of the home. So that's perfectly legitimate. But if you just take out a line of credit so you can go take an Alaskan vacation, right? No, you can't deduct that interest. So how do we know that? We've got to ask the taxpayer. Oh, this is why, and you have to be subtle about it. Introduce it that, hey, only certain types of interest are deductible. I see you have a second mortgage. Can you tell me what you took out that second mortgage for? And they'll tell you right away. Well, it's not want to, they do charge you a mortgage insurance premium. It's like an insurance policy that if you default on it and maybe the home value's gone down a little bit, that way the lender makes sure that they get paid everything. So here's a Form 1098. This is common what you'd see. If you see one, you're right away going to be thinking that chances are good you might itemize, or at least you might want to enter in all the itemized deductions, because this is usually a big chunk. And then here, so we've got several boxes here. Here's where they're going to report the mortgage interest that the borrower paid. In other words, this is a form that comes from Home Bank and saying we received this amount from the taxpayer. They give you an origination date. Sometimes if there was a mortgage insurance premium, it shows up in this box. If there were points, and that would usually be only in the first year, it shows up on this point, on this. I could take a little, never mind, I won't take a little detour on that because it's rare. Okay. Down here is where there was an escrow account and the lender was paying the property tax. So here we don't have to go look it up. The lender's only reporting what they paid during the year. So that should match the tax receipt that we would go look up. We won't have to go look it up. Okay. Here's kind of a mixture of screenshots for, first you would go into Schedule A interest, mortgage interest, and click on here. And it says interest reported on Form 1098. It's possible that maybe you're paying interest, the taxpayer is paying interest to their father who lent them money, right? And didn't give them a Form 1098. We could enter in that interest there, but then we have to report the father's Social Security number so that IRS can make sure that he's claiming the interest income on his return. That's rare. Usually this is the common thing that we get right here. And then you can, once you get to this screen right here, like I say, they combine two different screens here. Here's where we would put in the real estate taxes. So again, if you put it in here on this screen, don't put it in on the taxes screen. It would be double counting. And here we got interest and payment. Here's where the MIP or PMI, mortgage insurance premium deduction, would be put in. Okay, let's talk about charitable contributions. So can taxpayers deduct contributions made directly to needy individuals? Of course, that's charitable. The folks out in the median who are homeless, and you give them money. That's a charitable donation, but it's not tax deductible. It has to go to a qualified organization. Sometimes you'll hear those referred to as 501c3s. If you're not sure, you can go to irs.gov type in charitable organizations, and you can look up a list to see if they qualify, if you're not sure. But certain things like here's something that's common. It's like GoFundMe accounts, right? You know, the fires last year in Southern California. Maybe somebody set up a GoFundMe account for their relatives whose house burned down, right? You know, to help them get resettled. Well, I mean, that's good and it's charitable of the heart, but it's not tax deductible. It has to go to a qualified organization. Then also, if you're a volunteer, all of you are volunteers, and if you itemize deductions, you can take a charitable contribution for 14 cents per mile. So keep track of your miles if you're itemizing deductions. Can they take a deduction for a raffle ticket? And let me just talk about the general concept, right? If you're donating money, if you expect something in return or even the hope of something in return, it's not deductible. So in this case, you bought a raffle ticket, you're hoping you're going to win that trip or whatever. And so there's an expectation that you might profit by spending that. It's not a charitable contribution. And then the second bullet point down here about cash donation limited to 60% of taxpayers' AGI, it's true, you'll never run into that in a VITA program. Our clients, they're not giving away over half of their income. I mean, it's just, you won't see it. This is more for wealthier folks that, don't need their income, the Gates and the Musk of the world. And, there's a limit to how much they can give away and reduce their income. That's kind of what that thing is about. Okay, so here's the gifts to charity screen, and here's where you would put in cash gifts to charity, but then we're also going to talk about non-cash gifts to charity and non-cash donations that are more than 500. As you guessed it, that's out of scope, right? None of these you will ever run into where you have to do that. But here's an example of where you're putting in cash contributions. This is tithing to the church, right? Now they've been putting it in week after week. They go to church every week and put something in the basket. So we just total it up. They total it up for us. We don't ever put in that. They tell us. And here we can just put in the date being the last day of the year. Now, sometimes they've only got 2 or 3 donations, right? And we don't, instead of making 3 entries, we just go click on this override button and put in cash contributions without putting in this detail. In this case, we put in 3 contributions to show you here. We put in, here's the churches that we just showed you. And then the preparer had gone here and clicked on this add a cash contribution, put in one to American Cancer Society, one to Millsap Elementary. So they put in these, they put in a list or detail of these contributions, right? This is a non-cash donation. Okay, a couple of things I kind of want to help you about with here is first of all, if they tell you that they gave away more than $500 in non-cash things, goods, like to Goodwill or to Habitat for Humanity or whatever, we cannot do the return. IRS requires a whole separate form with very detailed itemizations of each contribution you made during the year. And we cannot do that return. Now, on the other hand, if they come in and they just say, yeah, I've got $750 of non-cash contributions, well, we might advise them that, well, look, what's the tax benefit you're going to get for that extra $250? Well, if you're in a 10% tax bracket, that's going to save you $25, right? We can't do the return. We'll have to refer you to a paid tax preparer. And they're going to charge you, if they're itemizing deductions, it could easily be $300 for an easy return, right? So you're going to spend $300 to save $25. You do not have to claim all those itemized deductions. We could just put in $500. Now, here's another scenario. You're sitting in front of the taxpayer. Yeah, I made these non-cash. Okay, how much did you make? Well, I don't know. What's the limit? And you might say, well, we can't do it if it's over 500. Well, yeah, put down 500. I would not do that return because first of all, I would tell them, look, you're going to be responsible for everything on this return. You're required to keep some kind of record of what you did, even if it's notes in a calendar, right? Because if you get audited, they're going to ask to see that. You're going to need to tell me exactly a number that you put in. Now, if they say, well, I know I put in way more than 500 and we're limited, okay, that's okay. But if, they first told you they dropped off a couple of boxes and then tell you to write down 500, you're kind of knowingly doing an inaccurate return, and we don't want to do that. Okay, record keeping, I just kind of mentioned it to it. It has, for cash donations, they have to have a check or a canceled check or some kind of receipt from the charity. A bank statement maybe containing the name of the charity, the date and the amount. They have to keep a record. And then IRS will sometimes accept notes in a calendar, that you've did, especially if the donation is less than 250 the one time. Otherwise, you need a receipt from the organization. Now, on that receipt, they're going to tell you how much of, if anything, of a value that you got back. For instance, maybe you went to a fundraising dinner. And they say, oh, thank you for your $100 contribution to our fundraising dinner. The value of your meal was $25. You can only deduct 75. You can't deduct the whole 100, right? We kind of went over that. So that's what this record keeping is all about here too. What are some non-deductible items? We already talked about the cost of raffle. Of course, bingo, lottery tickets, tuition. Maybe you paid tuition to a school or maybe it's even a church that runs a school, and you know that donations to churches are deductible, right? Not if they're for tuition. They're not. You can't deduct the value of your time of service, nor can you put a value on the blood that you donate. Okay. You can't deduct car depreciation or any other car expenses other than that mileage amount that I told you about, 14 cents a mile. You can't deduct direct contributions to individuals, sickness or burial expenses. And as I just kind of pointed out, the part of any contribution that benefits the taxpayer, that would be the meal you got in return for doing that. De minimis stuff, they call it de minimis stuff. I mean, if they give you a pen, that's got their logo on it, no, you don't have to reduce your contribution by 75 cents for the pen. But those are de minimis, but anything of real value, okay? Now, here we're getting back to if you're claiming Arizona tax credits or any other state tax credit, right? It's a direct reduction of the taxes that you paid. Okay, so if you're using a charitable donation to reduce your taxes, well, you're not going to report it as a charitable donation. You're going to report it as a tax payment. But if you paid more, if you donated more than what's allowable, then we're going to put that excess, we're going to enter that in under the itemized deductions menu. Now, let me reiterate. If they are not itemizing deductions, just enter the whole thing as a charitable contribution. That way the Arizona return picks it up and they get that additional standard deduction of 35% of their charitable contributions. That's just the easier way to do it. But if they itemize, you got to go through this extra step. Okay, cash, these were doing that. Yeah, good. So this is going to be kind of a reiteration of what we went over with Arizona tax. So I'm going to go over it really quick. Like in this case, we've entered in 3 donations for $1,500, right? This is the federal page 2 of the federal return. Here's page 2 of the Arizona return. And we get to take an extra 35%. We're taking the standard deduction, but Arizona will allow this extra 35%. In this case, used to be 27%. We're just using that whole thing. But here we get to take that extra. And we went over this before in see here it's 27%. This year, 2025, it'll be 35% that Arizona allows as an additional standard deduction. Wow. Okay, that was itemized deductions. Let's talk about payments and estimates. And this is just a couple of screens. Be really quick. We'll do this. Um, you could perhaps this is not common in VITA. Usually, we're helping people who need their tax refunds, right? And they're usually not subject to having to make estimated payments. What estimated payments are is if you have a balance due on your return and you haven't paid in at least 90% of it, well, 90 to 100%, it depends, 90% of the current year's amount. Let's say that um, your whole tax bill is $3,000 and you've only paid in 2,000 and you owe 1,000. Now the rule says you should have paid in at least 90% of the 3,000 that you owed, 2,700. Or there's also an exception that says if you paid in 100% of last year's taxes. But in any of those situations where there's an underpayment, you should have been making quarterly estimated payments. Our taxpayers, I've only run into a couple that we do this, but if that's the case, such as they're self-employed and they're not having withholding taken out, we should suggest to them, and we can go enter into here federal estimated payments and print out coupons for them to mail. It's not quite every quarter, but it has kind of dates for in there too. Now, what if they've got a refund coming and they know they're going to owe estimated payments and they say, hey, I want to apply the overpayment to next year's taxes? We could do that here. Here's where we could create those vouchers that we can print out for them, where that they can go make estimated payments during the year. And here's where we would create those vouchers. Here we would say amount applied from a prior year refund, right? In that first example where I said, here, apply it to the thing. Again, really important we see the last year's tax return because it'll tell us right there at the bottom of page 2 where they applied it to the next year. So we would put that amount in here. And then if they had been making estimated payments, we would put them in there. There's 4 that have separate due dates to it. So that's how we would put in those estimated payments. And then again, if the taxpayer has to put part or all of their refund towards next tax year's payment, we can put this in here. Okay, so that covers payments and estimates. And in our next video, we're going to start talking about health insurance or the Affordable Care Act or Obamacare or the marketplace. Goes by several things, and we're going to talk about what we have to do there. So until next time, we shall see you. Bye-bye.